Welcome to Uncovering Trusts, a podcast by Edison Group. I'm your host, Miłosz Papst, Director of Investment Company Content at Edison, and today I'm joined by Liam O'Byrne to discuss Canadian General Investments, or CGI. Liam, thanks for joining us today.
Thanks, Miłosz. Great to be here. Yeah, CGI is a distinctive investment company and one that I think probably deserves more attention from investors looking beyond the familiar US growth story.
Yes, I fully agree. So let's start with the basics. What is CGI and why is it distinctive in the investment company universe?
Yeah, so CGI is one of North America's oldest closed-end funds. It was established in 1930, listed on the Toronto Stock Exchange in 1962, and then on the London Stock Exchange in 1995. It's managed by Morgan Meighen Associates, or MMA, which has managed the portfolio since 1956 and has around 3.2 billion Canadian dollars in assets under management for private and institutional clients. Greg Eckel has been CGI's lead portfolio manager since 2009, and Victor Chung joined in 2024 as assistant portfolio manager. I'd say the proposition is best described as a one-stop shop for Canadian equities. So, as you might expect, the portfolio is primarily Canadian. However, it is worth noting that the mandate allows up to 25% to be invested in US-listed companies, where the team wants exposure to businesses or sectors that are perhaps underrepresented in Canada.
Okay, I understand. So it is mainly a Canadian equity story, but with a bit of flexibility. So how does the investment process work?
Yeah, so the process is fundamentally bottom-up, although Greg does keep the macro backdrop in mind. The team looks for reasonably valued companies with favourable fundamentals and strong management teams, and ESG considerations are also incorporated into the research. It is a genuinely long-term approach. The 2026 AGM presentation showed 54 holdings and portfolio turnover of around 11.5%, which still implies a long average holding period of around 8.5 years. The portfolio is biased towards large and mid-cap companies, and no single sector can exceed 35% of the portfolio. The managers are not trying to mirror the S&P TSX Composite Index, so the sector weightings can look quite different from the Canadian market.
Okay, thanks. So tell us about the most obvious differences versus the index at the moment.
Sure. So the largest active weight is financials. Canada is often associated with its banks. These and other financials made up around 1/3 of the benchmark at the end of May 2026. CGI's exposure was closer to 13% of the portfolio, so the underweight was around 20 percentage points. Financials is a long-term underweight position, and the manager generally finds better investment opportunities elsewhere. But then on the other side, CGI is meaningfully overweight industrials and information technology.
Okay, thanks. That's a useful high-level view of the portfolio. So maybe now let's talk about the portfolio in more detail.
Sure. At the end of May 2026, the top 10 holdings accounted for around 38% of the portfolio. The largest holding was Celestica at 5.5%, which is a Canadian electronics manufacturing services business that has been a major beneficiary of AI-related data center investment because it designs and fulfills specialized equipment used in that build-out. CGI initiated the position in mid-2024, and Celestica's share price more than tripled in 2025. So I think it's a very good example of the potential payoff from active stock selection. NVIDIA and Franco-Nevada were the next two holdings, both around 4.5%. Then MDA Space, a Canadian space tech company, and First Quantum Minerals, a copper-focused metals and mining company, completed the top 5.
Thank you. That's interesting. I noted that uranium doesn't feature in the top 5, but I understand it has become an increasingly prominent theme within the portfolio. Can you maybe explain that?
Yeah, that's right, and it's an interesting development. So CGI's energy weighting increased modestly to 16.5% by the end of May 2026, and a significant part of its energy exposure is made up of uranium. The fund's holdings include Cameco, NexGen Energy, and Denison mines. Now, the underlying investment case is linked to the renewed focus on nuclear energy, which is being supported by decarbonisation, energy security, electricity demand from AI and data centres, as well as the extension or refurbishment of nuclear reactors. And Greg sees uranium as an attractive long-term theme, although he is clear that shorter-term share price moves can be difficult to forecast.
Okay, and what about recent portfolio activity beyond uranium?
Yeah, several recent additions, I think, really help illustrate the breadth of the approach. One is Icon, a Canadian construction and infrastructure business that has been improving the quality of its operations and is well positioned for infrastructure spending in Canada. Another is Aritzia, the fashion retailer, which the manager views as an everyday luxury brand with a long runway for expansion in the US and also a strong e-commerce platform. A third is Bombardier, the business jet manufacturer, which has changed materially since exiting regional jets. The business has a more focused aviation franchise, a sizable backlog, and also now a growing defence opportunity. The point, I guess, overall is that CGI is a diversified fund. The managers are looking across the whole Canadian corporate landscape and selectively in the US for businesses that can compound value over time.
Okay, perfect. Thank you. And well, now performance is obviously central to CGI story. So how strong is the long-term record?
Yeah, it's very strong. Over the 25 years to the end of 2025, CGI's share price delivered an annual total return of 10.7%, compared with 8.1% for the S&P TSX Composite Index. Over 50 years, the annual returns were 11.8% for CGI and 10.5% for the index. So now in cash terms, 10,000 Canadian dollars invested in CGI 50 years ago would have grown close to 2.6 million Canadian dollars, compared with around 1.5 million Canadian dollars for the same investment in the benchmark. So I think that's a powerful demonstration of what a modest annual advantage can become when it's compounded over a very long period.
Yes, absolutely. And now, what happened more recently? I know that 2025 was, well, not straightforward.
That's right, yeah. So 2025 was positive in absolute terms, but difficult relative to the benchmark. CGI's NAV and share price total returns were 18.1% and 19.9% respectively, while the S&P TSX Composite Index returned 31.7%. Now, the Canadian market was led by gold and bank stocks, and CGI was underweight both areas. Gold had its strongest rally in over 4 decades, rising by more than 60%, and bank stocks were also very strong. CGI did benefit from its holding in Franco-Nevada, but this isn't a pure gold play. Then on the more positive side, Celestica was a major contributor, and First Quantum Minerals almost doubled, and long-term holdings such as Dollarama and Shopify also performed well.
All right. And how does CGI compare with peers in the AIC North America sector?
CGI is unusual because it is the only Canadian equity fund in the small AIC North America sector. Recent relative performance has been encouraging, and the long-term record is very commendable. Hence, CGI offers, I think, an interesting alternative to the traditional US-focused funds in order to gain North American equity exposure.
Okay, thanks. And now, one thing investors often notice is the discount, which is, well, very wide. Why is that?
Yeah, CGI typically trades at a wide discount to its NAV. This is because repurchasing shares to help manage the discount would actually invalidate the company's favourable Canadian Investment Corporation tax status, which allows taxes paid or payable on realised capital gains to be recovered through the payment of capital gains dividends to shareholders. Currently, the discount stands at around 40%, which is towards the wider end of its 3-year range. There is also a limited free float because a significant portion of the shares is held by related parties. The flip side, though, is that investors are buying a long-established Canadian equity portfolio at a substantial discount to NAV. Historically, there have been periods when the discount has been much narrower, so any improvement in sentiment towards Canadian equities could add to the underlying NAV return going forward.
Thanks. That's a useful explanation. Now, let's turn to dividends, because CGI also has an interesting income story, I believe.
It does, yeah. The board has pursued a progressive dividend policy for more than a decade. Between FY18 and FY24, the dividend was increased by 1 Canadian cent per share each quarter. In FY25, the increase accelerated to 2 Canadian cents per share per quarter, taking the annual dividend to $1.08 Canadian. In FY26, the first 2 quarterly dividends were 31 Canadian cents per share, which is 14.8% higher than the previous year. If that quarterly rate is maintained, the annualized dividend will be $1.24 Canadian per share. The current 12-month trailing yield is about 2.2%, while the prospective yield on that annualized FY26 run rate is closer to 2.4%. Now, the dividend is underpinned by the fund's ability to pay both regular taxable dividends and capital gains dividends, and also by the sizable unrealized gains in the portfolio.
All right. And I presume CGI uses leverage as well. How material is that?
Yeah, leverage is a meaningful but controlled part of the structure. So CGI uses a bank borrowing facility. At the end of May 2026, net gearing was 11.4%. The managers used leverage since 1998, and the strategy has historically added value. Of course, it works both ways, though. It can amplify returns when markets rise and losses when markets fall. In the context of CGI, it is another tool used to support long-term shareholder returns rather than a short-term trading lever.
Yes, of course. And now, for completeness of our conversation, what should investors know about fees?
Yeah, the management fee is 1% per year of the market value of CGI's investments, adjusted for cash, portfolio accounts receivable, and portfolio accounts payable, and there is no performance fee. The AIC style ongoing charge, excluding leverage and transaction costs, was 1.4% at December 2025. Now, that is not low relative to the broader investment company market, and it is something to flag, but I guess the proper question is whether the long-term performance, differentiated exposure, and active management justify the cost. I think when you look over the long term, the answer has to be yes.
Of course. Now, before we wrap up, how are the managers thinking about the Canadian investment backdrop?
Yeah, the Canadian economy remains relatively muted, and trade uncertainty with the US is an important risk, particularly with the upcoming renegotiation of the Canada-US-Mexico Free Trade Agreement. At the same time, the Canadian market has benefited from hard asset exposure, including energy, uranium, as we've discussed, copper and gold. And Canada remains home to high-quality industrial technology and consumer companies. The manager's message is that the macro environment, of course, matters, but it is not core. It is not the core of the investment case. CGI's long-term record has come from identifying individual companies that can outperform over time, and that remains the focus.
Liam, that's a very comprehensive tour of CGI. To close, how would you summarize the fund's appeal for potential investors?
Yeah, to summarize, I'd say CGI offers a rare combination: a fund with a long pedigree, a differentiated Canadian equity portfolio, and a 25 and 50-year record of outperformance versus the Canadian market. The current portfolio gives investors exposure to themes such as AI infrastructure, uranium, infrastructure spending, and selected high-quality Canadian consumer and industrial businesses. The progressive dividend also adds an income element, and the wide discount means investors are buying the portfolio at a substantial valuation gap. The discount is structural and it is unlikely to disappear overnight, but for long-term investors seeking North American equity exposure, that is not simply another US growth fund. CGI is well worth examining closely.
Thank you very much, William. Fascinating discussion about one of the most distinctive investment companies in the North America sector. You've been listening to Uncovering Trusts, a podcast by Edison Group. If you want to find out more about CGI and other investment companies we cover, please visit www.edisongroup.com.